Here's another late development, and this news keeps coming in as we're talking here.
This week, we are closing up our read on the book called Calculated Risk by Kevin Trades. If you're not aware, as we said it multiple hundred times, the retail price is $100, but you can get it for a discount of $42, basically by using the discount code TRADETRY. The link is up here. It's also on our social media pages, so definitely go check it out. And I feel like now that we've read this last chapter of chapter 3, this book is a godsend. I will not lie to you. I am not overhyping at all. I've had personal conversations with Kevin, and I think this is a really great book. And the fact that he's put it for this amount low price is honestly
that was the part that made me say sus at first, like, because it gives you such a rudimentary understanding, and then once you've acquired the basics in chapter 1 and chapter 2, it then gives you the secret here in the 3rd chapter. And I was just like, why are you doing this? And it kind of spoke to like this notion of just because you give somebody the answers doesn't mean they know how to mark it on a test. And so don't ever hoard knowledge, because it still takes effort to get the answer right.
Big facts. But that's the thing I love about this book, because literally in chapter 3, he literally tells you how do you go fill out that answer sheet. He literally gives you all his strategies, when to use them, when not to use them. He tells you this is like when it best use. Like, he literally breaks everything down in a short way. And like, I need to go back and reread that 3rd chapter and start practicing it. I need to literally just print it out, put it on my wall, go look at it when the markets are open.
Yeah.
But I think that's really great, and we're going to dive into that right now. But I guess as a recap of the first 2 chapters, the biggest things we learned was just the fundamentals. How do you get started into stock and options trading? You know, choosing your brokerage platform. What's the difference between stocks and options? He talks about calls versus puts, in the money versus out the money, options Greeks, options chain. What makes up the price of an option, from intrinsic value to extrinsic value to the time value, which is on the flip side, time decay. He talks about volatility, volume, and open interest. If you missed any of our episodes, or if you didn't catch this, we talked about it on a previous episode. I know we talked about it on episode 5 and 7, so definitely go check out. But this book, this chapter 3, which is our focus this week, the biggest takeaways, as you see on our screen, were really how do you take what you know, which is the fundamentals or fundamental analysis, and tie that into technical analysis. And I feel like the biggest thing is, with technical analysis, for those that don't know, is basically how you analyze a stock using different measures, metrics, and things like that you can like quantify or display graphically. So if you're not looking at the news, you can look at a stock chart and say, okay, based off this indicator or this value, this is what's going to happen. And it's really useful for predicting and finding patterns, especially stocks that have repeating patterns, or finding trends, or stocks that are about to really take off. It's pretty much your crystal ball or looking into the future of a stock. And he really spent a lot of time really explaining this and breaking it down for someone that's not familiar. The next thing he talks about is using the ideal time frame for your trading style. And something that we preach a lot on this calls is everyone is different. I'm different than Heero. Heero is different from Javier. Javier is different from Ozzy. And every one of us is going to have a different trading style. But the biggest thing is to find what works for you. And one of those biggest things within technical analysis is finding the right time frame. So for me, I'm more of a swing trader. I'm more of a day trader. So I'm going to look at the shorter time frame. So the 5-minute chart, sometimes even the 1-minute chart, the 5-minute charts, the 15-minute charts, things that are on a shorter week thing. So maybe 5 days, 5 minutes, things like that. Versus Heero, he's more of a long-term player. He looks at dividends. So he's going to probably look at the 1 month frame with 4-hour charts. 1-hour charts, things that are much more macro. But another great thing he said is to really use a few amount of indicators, but multi-frame analysis. Because a lot of things that happen is something might be happening on the short term, but it's not telling you what's happening on the bigger picture. And basically, if you can combine both and learn how to balance both, you can literally predict everything. And I think that is very valid, and it will help you, especially when you're trying to find out, okay, should I get into this trade? It helps your conviction on whether it is, because then it's pretty much telling you, hey, what you think or what you're looking into is right or is wrong. So basically it tells you, hey, this is the right thing to do. And if you need any help coming up with your investment strategy, do check out the last episode. We did talk a lot about how to come up with an investment strategy. The next thing, I guess, anybody have any questions on those parts before I continue, or anything they want to contribute or talk about?
No, I think you hit it on the head, nail on the head. Timing is everything in the stock market. You're competing, especially options, because you're competing against real people now. People who have vested interest in seeing you fall for tricks and traps.
I would say since like joining the club and everything, the tribe, like I was always like just like long term, but now I have a base long term, and now I'm looking into more short term stuff like Taufik said. So I just wanted to say that basically.
Yeah, there's nothing wrong with having a mix of different strategies. Of course, you want to focus on one and learn that so you can master it. But there's nothing wrong with having maybe one that you use in cases, in special situations, like this is gonna happen, so I'm gonna enter here. I think you did that with your first option trade. You saw an opportunity and you got into it and you came out with profit.
Yeah, I did. That was actually, I was in it for about like 10 minutes and I made probably like 80% profit. That was pretty crazy.
Can you say that again? You said you made how much and how long?
Like $80 in like really like 10 minutes.
Hey, that is dope, man. That's just the beginning. It gets bigger from here on out. But yeah, it's really interesting seeing that. And I think they kind of touched on that too. Another thing I learned from the book was for people that are interested in like smaller accounts or just beginning, a great way to start is to use spreads or short-term trades that the reward outweighs the risk. And basically, if you don't know what a spread is basically a strategy or a way of buying into options. And when you buy one option and you buy, which is called the first leg, and you buy another option, which is called the closing leg. And basically, by buying that combination, you can get a different effect. And one of the effects of using spreads is you get a lower cost, lower risk, much less volatility. And for those that don't know, volatility is really good or really bad. And we'll talk about that later. But you can also get, but with that, you get less profit, which is kind of bad, but it's still good as long as it's guaranteed, less risk. They also have more time decay. So if you're buying two options instead of one, of course, it's going to be more time decay, meaning that the longer you hold it, the more it approaches a value of zero. But basically, there's two types of spreads. There's debit spreads and credit spreads. Debit spreads are basically when you buy two options and you still end up putting money in, like paying for it. So basically, you're paying to get these two options. And there's credit spreads. Credit spreads are basically when you're getting paid for putting out this spread option. So basically, like say I have 100 shares of McDonald's and I want to buy, or I guess sell a call and make money as the time decay. So essentially, time decay works in the sense that as you're holding onto a call, someone else is getting money. You're basically paying someone else, and that's where the time decay really comes in. So basically, with the credit spreads, you're basically opening the contract and selling it to someone, and that person is paying you that premium, so you get your money up front first. Then, based off the end of that expiration date of that contract, it determines who keeps the money, if that makes sense. So as you're buying a contract, someone else out there in the world is selling a contract to you. So when you pay that premium, at the moment you click an option, someone else is getting that premium and they're holding on to it. And if you're right, you get how much it's worth in the future versus them losing that much, if that makes sense. So if you made $100 off your contract, that person lost $100 off their contract, which is the same contract. And that's basically how spreads work. The benefits, again, are less cost, less risk, less volatility, but the cons are less profit and more time decay.
I'm gonna put one more con on that a lot of people don't know about, that you would think if you do a spread, you have to understand that if you're gaining on the call but losing on the put, you can't close one without the other. You have to close them both together. So it requires you to have another person losing, which is the person who's going to pay you up front, and yourself to be beating someone else's who expects you to be losing. So you have to beat two odds in order to get out. And because you hold two separate contracts, it will wait until it's advantageous for one of the other people. So you don't get greedy with spreads. Once you make your money, You're
Get out.
15%. Like you're never gonna make 80% profit on a spread unless something goes wrong.
Yep.
If you're using spreads, you're playing it safe. So you should be fine with taking a safe profit.
Yep, and that's actually a really great point that you said, Heero. Know your exit out, because again, time decay is against your side. Profit is limited, which is the downside. So get your profit, get out. Don't stay in too long. But you also bring another great point where spreads, that typically, as I said, they're made up of two contracts. The first, and these contracts could be any contracts. The first one could be a call. The second one could be another call, but at a different price or expiration date. Well, no, it's on the same expiration date, but a different price.
Yeah.
So either less, and that's typically how the spread works. You buy one at a higher price that you think is going to win, and you buy another one which is at a much higher price, but costs less, but it will be the opposite of what you're doing. And basically that hedges and reduces you losing out on one. So if the first one doesn't go right, okay, you're still gaining on the other one and reducing the amount of loss. That's the main reason why people get spreads. But again, it could be a combination of a call and a call, or it could be a call and a put, or it could be a put and a put. It could be any combination of the two. And that's why it's a lot more complicated, but it's better for people that are looking to start and not lose all their money. And yeah, going into the more into the options, they do talk about what kind of options you should look for. The biggest value of options is to trade big names for volume and liquidity. So bigger names like Apple, the Microsofts, the Teslas. These are big companies that have big market capitalization, whatever it's called. But because they're big names, they have more people trying to buy or sell those things. So there's more liquidity and more volume. And that's where the value of options come in, because you don't want to get into options, which is much less volume than stocks, and then get stuck in a trade. Because so if I go buy some random stock that no one knows of, there's a high chance that no one's going to take my contract. And because of that, I'm going to lose money almost guaranteed. So use volume as a confirmation for your trade. So if there's a huge volume or spike in the trade that you're looking at, that's confirmation for you to get in or get out. Because that's typically a sign that, hey, I think this asset is moving, so you should move as well. But yeah, that is another thing. Another thing that I learned from the book was to pay attention to overall markets, trends, indexes, and ETFs. Those give you insight into what's going on with the stocks or specific call outs you're looking at, such as, say, all of tech goes down. It's typically because of Apple or something like Apple releasing something or Tesla releasing something. And because of that, my stock in Microsoft is going to go down too, even though Microsoft did nothing. It's really good to pay attention to the market as a whole, using indexes like S&P 500 or just trends within the industry. If tech is going down, obviously your tech stock is going to go down. Same thing with oil and any other stocks that you're looking at, stuff like ETFs, things like that. If you don't know any, definitely look up what are the most popular ones. There are a couple that are great, like the SPY, that's S&P 500. Y'all know any other ones that are good to track?
You can't go. I mean, there's a bunch of like multiplier ETFs. I'm always down for a multiplier ETF, especially if I know I have a good hunch on it. But I trust. The thing I don't like about the SPY is it can be so negative sometimes, because you see one in the SPY go up and it won't have the same ripple effect, and you're banking on one company's there. And a lot of these like ETFs and stuff like that, they bank on one company in the group to kind of dictate the flow of the day. And I hate that, because why bank on someone who's looking at someone else? Just bank on the person everyone's watching.
Facts, and that's why it's good to pay attention and not really bank on it, if that makes sense. Mm-hmm. So there's a difference between paying attention to it and saying, okay, because this is doing that, I should go do this.
Yeah.
But that's a great point, though. That is a great point. Any other ETFs that y'all track, Ozzy, Javier, or indexes?
Nah, not really.
I haven't really been paying attention to mine. But yeah, I have some Vanguard ETFs. Those are literally for my 401k. So, yeah.
Facts. That's a good one.
The thing that I think another way you can look at it is just that you have to. You can't come and say that you want to make if you're making a one open option trade, that's great. Hey, more power to you. But you'll be a lot more on par to make these option trades if you understand the market of the trade you're making. If you're in tech and you're not following the big three, if you don't understand the big three's flow, if you haven't micromanaged their charts before, then it just doesn't feel genuine. I think the other week you asked me about SBE, and I said to myself, okay, before I give you any advice on this, let me look at their options for the day. And I was looking at their Greeks, and I was just like, yeah, we'll talk about it later. But before I could give you an answer, it's not enough just to look at their chart for the last 3 months. You have to also go into their option trades and see how have they been trading for the last 3 months. How do people who make money make their money, and how do people who lose in this market lose their money? Like, what are the things that trick people in the option trade? Option trading is about tricking someone else across the map. Period.
That's facts. It sucks to hear, but that's facts. And that's actually another point also in the book that they kind of talk about. And it says, follow smart money and sentiment, not news. That was super powerful to me. When I read that, I was like, whoa, that just blew my mind.
Yeah.
And for those that don't know, smart money is basically the funds or money moving around the market that are owned by large institutions or people that have insider information. And you will see it in the market. You see the footsteps left behind. And if you can find that, you can basically make profit as they're making profit. Like, say I work for a company like Pfizer, and I know for a fact Pfizer's vaccine works before the public. What am I gonna do? I'm gonna throw all my money into Pfizer, and guess what? That money is gonna pop up somewhere in the charts, as you said, somewhere on the options chain. It's gonna show up, and if someone else like Heero is paying attention, he's like, for some reason, someone made put this much money in Pfizer, so I can put my money in Pfizer and make the same amount of money that he's.
And another thing is, like, people really, the option trade, the breadcrumbs of billionaires can turn you to a millionaire. Yep. So like, people be out there trying to get that big dollar trade, and I just be looking at, I will make 4 small contract trades and walk away versus putting 6,000 up front. Because if someone sees that and they say, oh, 6,000, I'll take that off your hands, because they know they can outweight you. They got contracts going all the way to 2022. So they don't have to compete with your 6,000. They can outlast you. So I always say, get the breadcrumbs, man. You can become a billionaire real quick.
That is facts. And because of that, that's one of the reasons why I don't invest in Robinhood. Because the one thing that Robin does, people don't pay attention, is Robinhood doesn't make money off of you. They give you the platform and the tool for free. What they do though is they send all your information, mainly your what's it called, your order history, and whenever you place buy on McDonald's stocks, they send that information to huge hedge funds, quantitative traders, big financial institutions. And what they do is they take that and basically play against you. They're like, oh, you bought one stock in McDonald's? All right, bet. We're going to make McDonald's drop so that you lose money and we make money. It's crazy. And that's literally 70% of their revenue. So they're doing this a lot. And that's why I don't buy into it. There was at one point I noticed, I was like, my trades should be working, but for some reason it's not working. And I was like, it didn't make sense at the time, but it kind of makes sense. Maybe
Robinhood has ruined the game for them, and I can see new laws coming into play in the near future to fix this, because trading was a rich man's game before Robinhood came around. The thought of having to spend it's kind of stupid when you think about it. Now, in order for you to make this $30 option trade, you got to spend $1. That was enough to keep people like, nope, not for me. But now that it's free, just look at how the market, like Zoom. There's 2 companies named Zoom, and I think one is ZOOM and one is ZOM. Yep. And on the day that Zoom started spiking, that other nobody-ass company spiked on the same day because idiots were like, oh, okay, this is the same one. I'm going to buy it. Right. It's crazy. Zoom, like, God bless Robinhood, but it's also made it so that we have to compete with dumb people. At least before, there was a strategy behind it. Now it's sort of, you have to go in these winding waves when the dumb people come in and when they leave out.
And that's actually a great point, because the SEC did halt that stock when that happened. They literally paused and said no one can trade it for the next day because y'all messing up. That was funny to me. But that's a great point. Like, it definitely is. Robinhood started out as this great platform. Oh, it's leveling the playing field. And I feel like that may have been the original intention, may have not been, but it did help people. Like, for me, I started off Robinhood. That's why we're here. Like, I started off on Robinhood, and that was great. But I'm seeing, okay, their real business is selling my information to somebody else that will play against me. So it's okay. I'm gonna move my money somewhere else. So I think it's still a great platform for beginners, but I just think people should be aware of what is going on with that platform. Hopefully they fix this and it truly becomes a platform for leveling the playing field between the rich and the poor, but we'll see from there. But another point from the book, they said, follow sentiment and not news. Once you understand the difference of these two, it's super powerful. The basic summary is news is what they tell you, what the media is telling you, what the company is telling you. But sentiment is what people are actually doing based off that news. The news can tell you, oh, this stock's going to go up because of this reason. But if you follow that news, you lose money. But if you follow the sentiment, it's just what is everyone doing based off that news, they might say, oh, no, because of that, it's not going to go up, it's going to go down. So we're going to sell. You follow sentiment, you make money and not lose money because other people are doing what they're actually trying to do. So again, follow smart money, follow sentiment, and don't follow news. And we'll probably have a segment on that in a future episode. Last few things before we wrap up this segment and go into what y'all really care about. Understand how to use stock business strategies. Again, the way you become a trader is having a strategy, sticking to it. But because of that strategy, you pretty much create a strategy based on a pattern you recognize. Like, is it because when someone says this, the stock market goes up? All right, I'm gonna do that now. Whenever this meets my requirements, I'm gonna do that. Maybe it's a trend line. Trend lines being a way to say, okay, is it uptrending, downtrending, or going sideways? Flags, different stock patterns like bullish flags, bearish flags, pendants, ascending triangles. You've probably seen a cheat sheet with like different ones on there. Those really have a lot of value. And also candlesticks and zones. Candlesticks, the way the candlestick looks can tell you a lot of information about what is about to happen in the next couple minutes. Zones, they tell you, okay, who is winning? Is it the buyers? Is it the sellers? Is it the bulls? Or is it the bears? Zones are very useful. And if you can understand zones, I think you're an expert trader at that point. But that book talks more about it. Lastly, another one that I got, there's so much stuff in this book that we probably can't cover it in this segment, but another one was that breakouts typically happen around fundamental triggers. And basically what that means is when you see a stock going up 10% in one day just for no reason, it's typically because of fundamental trigger. And the fundamental trigger is basically something that causes the stock to go up, to move around the line. That could be earnings report, product launches, acquisition, mergers, bankruptcy, anything that can move or change people's opinions of that stock. And yeah, it's so much to go over in this book. I literally cannot summarize the chapter 3 in this short 20 minutes. I definitely recommend that you all go in and actually read this book, get this book. We give you a discount, so you really have no excuse. But it tells you everything you need to know. I'm about to keep diving in with chapter 3 and trying to really practice what the things he's teaching. But if you would like a part 2 to this, leave a comment, subscribe, all that stuff, and we could probably expand upon this book even more. And then especially as I practice what it kind of taught. Besides that, any questions about the books, any other comments, things y'all like to add? Nope. And that basically wraps it up. Unless y'all want to hear more, we'll talk about it in a different episode. And that is our book club of the week.